Hello everyone and welcome to our preview of the US jobs report. My name is Craig Erlam, Senior Market Analyst at OANDA. This is a similar video to the one we put out yesterday ahead of Super Thursday, the Bank of England event, when we had the Bank of England monetary policy decision, the press conference, the inflation report and the minutes being released. Today's focus is on, as you can see from the title, the US jobs report. We actually did one last month as well, which was quite well received, so hopefully you guys find this just as useful. You can see here we're going to be looking at a few charts, but first and foremost, let's bring on the economic calendar here and bring up the key points that we're looking for from the report itself. Now, for those of you who didn't watch it or aren't aware, this is the OANDA MarketPulse website. This is where we put all our content every day, written content, fundamental content, videos, technical analysis, the lot. We've also got access here to the economic calendar. You can see here, click on this link and it brings you to the calendar. Now, I have filtered this calendar just for events on Friday and focused down on the US so that we can get a look at the jobs report data. Now, as you can see, there's a lot of other things happening Friday with regards to the US. You've got things like factory orders, non-manufacturing PMI, services PMI, got Charles Evans, Fed policymaker speaking. We've also got the Baker Hughes oil rig count, but it's this part at the top that I'm most focused on because, well, this is the point of the video. Now, the US jobs report is widely regarded as the biggest piece of economic data we get each month. Really, generally, not just from the US, but certainly from the US. The reason for this is because the Federal Reserve does have a dual mandate. The mandate is full employment and inflation 2%. Now, the great thing about the jobs report is you do get the employment statistics. You get unemployment rate here, which is expected to be at 4.7%, which is around what the Fed deems to be full employment, maybe just above at the moment. There does seem to be a bit of debate over where that'll be. You can see just how far it's fallen from those recession highs when it went above 10%. So now we're back at around 4.7%, which again, pretty much right around the level we were pre-financial crisis. So you could argue that the Fed has pretty much achieved that goal. Now, it is worth noting that the Fed has achieved this goal despite the fact that participation has not recovered in the slightest. In fact, it's still around these post-financial crisis lows at around 62.7%. This has been a constant thorn in the side for the Federal Reserve. It's a conundrum that they can't seem to quite solve at the minute. Why is everything else recovering? Why is the economy growing? Unemployment's falling. All the metrics which would suggest the economy is looking quite healthy, and yet the labour force participation rate, which is the percentage of the people who can work that are either working or actively looking for work, and at 62.7%, this is right down at multi-year lows. So this is something that they can't resolve, and the problem is the lower the participation rate falls, the lower it actually weighs on the unemployment rate. So sometimes you'll see the job creation number, the non-farm payrolls, actually be quite low, yet unemployment will fall because the participation rate declines. We saw that here back in November or December. We saw a drop in the participation rate, and then we saw a corresponding drop in unemployment as well. So it makes the unemployment figures look better than they can be at times. So I think this is going to be a key task for the Fed going forward, but ultimately unemployment still is very low. The other aspect of the jobs report, which does tend to write the headlines, is the non-farm payrolls. This is the number of jobs that are created each month. Now, we've been at around this 175, close to 200,000 figure on average, really, for quite a long time now. Now, it was above 200,000 for a while, but as unemployment has fallen, that number has started to fall as well. That's just what we see when the labour market is much tighter. There's there's more jobs being created. There's when there's less when unemployment is falling, there's less people searching for work. You do tend to see the number of jobs creating gradually start to decline. Now at 175,000, that's still extremely healthy. If we do get something in line with that, it's well above what the Fed deems necessary for the unemployment rate to continue to drop. And what is interesting is we actually had the ADP number on Wednesday, which I won't bring up here, but that was, I think it was around 236,000, so that was well above expectations. So really what this suggests is the consensus forecast for this number is 175,000 jobs to be created. If it falls in line, or roughly in line with the ADP released, ADP being a private processor of payrolls, and they deliver their Payrolls figures 2 days ahead of the non-farm payrolls and generally seen as a rough estimate of the payrolls figure, although again it's arguable how accurate it is. If it falls in line with that, then this could provide a big upside surprise, which may be dollar positive at a time when the dollar's actually coming under a little bit of pressure. It's around 4% off its highs of the year. Since the start of January, it has just been on a steady decline. Perhaps the Fed raising interest rates and signaling its intentions in December, and the market really buying into this, combined with the Donald Trump inauguration and the constant efforts by the Trump administration to talk down the US dollar, talking about other countries as having manipulated their currencies lower. I think these things are potentially weighing on the dollar. Maybe Donald Trump is laying the groundwork for the next his next battle, trying to weaken the dollar, despite the fact that the US is the only major economy where we are actually seeing rates rise. But like I say, so there is potential upside for the dollar. So if we see a beat in line with the ADP, we could potentially see the dollar rise. But we'll touch on that in the charts in a second. The most important aspect of the report, in my view, and I think many people are in agreement at this point, is the average hourly earnings, because this focuses on the other side of the Fed's dual mandate, the other side of the Fed's dual mandate being inflation. Now, often we'll see inflation on the rise because of rising commodity prices or because of a weaker exchange rate. But neither of these are really particularly sustainable. These tend to be transitory factors. I think a more sustainable inflation tends to be driven by an improving economy and by earnings rising. So the more people earn, the more they're likely to spend. And as you've seen here, since the start of 2015, earnings have been on the rise quite steadily. Now, we're not back at pre-financial crisis levels yet at around 4%. I'm not necessarily convinced we'll get quite that high, but even if we get close to that, it'll be a benefit. But you can see from really 2011 through to 2015, this was just really moving sideways. We weren't seeing much progress at all here. But then since the start of 2015, we have seen that line steadily start to rise. And now we're up at around 2.9%. And the trend is very much in our favour. For me, this is a sign that inflationary pressures, sustainable inflationary pressures, are building, and I think this is going to be a metric that the Fed is going to be paying very close attention to. It's also a sign of strength for the consumer, and the US is a consumer-driven economy, so wages rising is, of course, a very good thing. Should we see another strong figure here, even a dip above 3%? Then I think that would be extremely positive, and again, that could potentially translate through to US dollar strength. Now that's the fundamentals covered. Let's take a look at a few charts. Let's start with the euro versus the dollar, and what I find interesting here is that we are really trying above 108 ahead of the release. Now, of course, this is being recorded on Thursday, so please forgive me if these charts are potentially a little out of date by the time the actual jobs report does come around. It is just meant to be a guide to how things are trading, as opposed to be taken in any way literally. And of course, as you'll see on the disclaimer at the end of this is not trading advice in the slightest. This is just educational. But around 108 is where we've got a number of areas of resistance. You've got from here prior levels of support, which I think is always important. You've also got the fact that we've broken through the moving average band, which is quite bullish, but it's also the 50% retracement of the move from the November highs through to the December lows, which is quite often quite a key technical level. I think should we see a break through these 108s to 108.30s, then I think we could potentially be looking at a move towards these 109.50s, where this descending trend line from those May 2016 highs comes into play. You've also got the moving average band just above that, and it's worth noting as well the 109.33s, which is the 61.8% retracement again of that same move. So I think the 108 to 108.30 is key, with a break above that potentially signalling a move towards the 109s. We touched on cable yesterday, so I'm only going to be brief here. We've broken through these 120, this possible resistance here around the 120.675. We've broken through there today. It's interesting the fact that we did come back towards these 124.50s a few days ago before rebounding high. This is the combination of the moving average band, but also that prior level of support and resistance as well. But it looks like we've made a new higher high today, which for me brings into focus this 128 to 120 850 in the cable pair. I think given the fact that this is a major level of support here previously, and it's been resistance also, would suggest to me that it's going to be an important technical level, although I do think this has been an important break on the moving average band. Through here we'd be looking at around 131 through 133, again a prior area of resistance, but also that moving average band of 200 and 233 potentially being important. Australian dollar versus the US dollar, we've seen a really strong surge in the Australian dollar overnight. Now, highlighting a point back in a previous video, we highlighted this 75 level as being key. You had the confluence of moving averages, prior zone of support and resistance as well. We did break through there a couple of weeks ago, and then we saw that retested, a nice area of support, confirmation of the break, and since then we have just seen it take off. 77 to 78 remains the next important zone of technical resistance for me, given the fact that if you look throughout this period here, you've got 1, 2, 3, 4, 5, 6, 7, 8, 9, almost a dozen occasions, and plus back here when this has been technical resistance. There's no reason to believe that that won't happen again, but a breakthrough here, we could potentially see a move towards these 80.30s to 81.50s. Again, a wide band, but you can see that the gap in between is quite significant as well. But I think in the meantime 77.78 is extremely important for Australian dollar versus the US dollar. Dollar CAD, again relating back to the previous video, we saw the rebound off the 61.8 fib from these highs on the December highs to the January lows. We saw a rebound off the 61.8 fib, a nice evening star formation, and a rebound lower. We've actually taken out the lows. We've taken out this area of support again today, as we did a couple of days ago. Should we take out that previous low, or at least get a close below this support level, we could be looking at a move back towards these 128s to 128.50s. Again, an important area of support. Back in around the August-September time, but even before that as well. You can see here back in March and also in May as well. So I think 128 to 128.50 could be potentially on the cards for this dollar CAD pair, which would be in keeping with the overall trend. We saw the sell-off here from January through to April of last year. Then we then saw a bit of a move higher back, and I think this is actually the 50% retracement of that move. We saw the rising channel, and a break below the channel was the signal that we were potentially looking a lot more bearish here, and that's how the move is currently materializing. New Zealand dollar versus the US dollar, and again we have run into resistance around these 73.50s, and again you look at this period here, we saw these 73.50s were an important zone of resistance during that period, but it was also a technical area of support here, back here as well. But again, the fact that we've broken through that descending channel is potentially looking quite bullish here. I think the next real notable area is around these 74.50s, 75s. Previous high, but also a previous area of support around these regions as well. And it's also the 50% retracement of this entire move, so this will be a big test of the trend. Is the trend actually going to continue lower off that 50 back, which would be a second failure to break above it, or if we move through, are we looking more towards these 77.50s through 78s, which again, prior zone of support, but also the 61.8% retracement of that very same move. Two more charts to finish up on. First is dollar yen, and again we are seeing a little bit more dollar weakness ahead of this report, but we are back in that daily Ichimoku cloud as well, which I think is quite important. It looks as though we're potentially testing the lows from a couple of days ago around these 112s. In reality, I think we're finding support here around the 111.50s, 111.40s, but ultimately it's back here where it matters. They want around the 110, 110.50s, the lower part of the moving average band, but more importantly, the lower part of the Ichimoku cloud as well. A breakthrough here is particularly bearish for me, and I'm not convinced at this stage that that's going to happen, because ultimately I do see the yen as remaining one of the weaker pairs in the long run, given the fact that they are continuing to keep rates on the yield curve at the longer end at or around zero, and we're still in a tightening environment in the US. So I do think this is temporary this strikes me as being temporary weakness for the dollar yen, and I'm very intrigued to see around this region now whether we do see some of that buy the dip mentality, and so far it would appear we've been stuck in that trading range around 112.50 through 115 for the last few weeks. We are testing the low end of that, but clearly that buy the dip mentality is very prevalent still in dollar yen. We just haven't had that catalyst for the move higher because of these efforts to drive that US dollar lower. The weakness in the dollar is paying off for gold though, and it looks as though we are seeing a breakthrough these highs. We're stuck in a range around those 1180s, 1200s. You can see the 55-89 day moving average band providing both support and resistance here. We have broken through the top of that band, and now we're testing the previous highs. Through here, I think 1230 is going to be important. That's the 50% retracement of the move from the November highs through to the December lows. If we see a breakthrough there, then again 1250, 1255 is very important. 1250 due to the fact that we do often see the 50s, the zeros provide interesting support and resistance. We've also got the fact that you've got the Fibonacci, but it's also a prior zone of support as well. So should we see that, it looks as though we're seeing a 1220 broken, 1230 is the next. If we see that broken, 1250, 1255 I think is going to be a very important zone thereafter. As always, I hope you found this useful, guys, and any feedback, please just leave comments below. Any charts you want me to cover, I'm always happy to add more charts to help everyone out. Apart from that, please tune in again next week, and we'll be releasing a few more videos. And I wish you all the best of luck with your trading, and have a great weekend. For more in-depth news and analysis, check out OANDA MarketPulse at marketpulse.com. You can also find out more about OANDA and sign up for a free demo account at oanda.com. Here you'll also get access to OANDA Forex Labs, which has a lot of great tools designed to help you with your trading.